Okay, let's just dive right in. If you own any kind of property in Canada, your home, a cottage, a rental unit, you've probably heard the term capital gains tax thrown around. It's one of those super important financial things that can feel kind of confusing, but you really have to get it because it determines how much money you actually get to walk away with when you sell.
So let's kick things off with a big, practical question. Just imagine this. You sell an investment property, and boom, you've made a $300,000 profit. That's amazing, right? But the Canada Revenue Agency is going to want a piece of that pie. The real question is, how big is their slice? How much of that incredible profit do you actually get to put in your pocket? Well, that's exactly what we're going to figure out.
So, to figure out how much tax you're looking at on that 300 grand, we've got to get the basics down first. Let's start with the most important idea. What exactly is a capital gain in the first place? Honestly, at its heart, it's pretty simple. A capital gain is just the profit you make when you sell an asset, what the CRA calls capital property, for more than it cost you. And that includes all the expenses involved, of course. We're talking about things like a rental building, a family cottage, or even stocks and bonds.
Now, here it is. This is the single most important number you need to burn into your brain when we're talking about capital gains in Canada. 50%. This number is the absolute key to the entire thing.
So what's so special about 50%? Well, that number represents something called the inclusion rate. See, unlike your salary, where every single dollar gets taxed, the government says, hey, with capital gains, we're only going to count half of your profit as income. So that $300,000 profit we were talking about, the CRA only even looks at $150,000 of it.
Okay, so we know only half the gain is taxable. That's great. But how does that turn into an actual dollar amount on a tax bill? Let's walk through it step by step.
There's a really clear four-step process. First, you figure out your real profit. That's the sale price minus all your costs. Simple enough. Second, you take that profit and multiply it by 50%. That's your taxable gain. Third, and this is so important, you add that taxable amount right on top of your other income for the year, like your salary. And finally, that new, much bigger total income is taxed at your personal marginal tax rate. And that is a key point. There's no flat capital gains tax rate. Nope. That extra income just gets piled on top, meaning it gets taxed at the highest rate you pay.
All right, let's put some real numbers on this to see how it works. Imagine an investor in Toronto making a salary of $150,000 a year. They've got that $300,000 capital gain, so 50% of that, $150,000, gets added to their income. For that one tax year, it's like they earned $300,000. And because of how Canada's tax brackets work, that extra cash gets taxed at a really high rate. So what's the bottom line? That $300,000 profit ends up costing them about $60,000 in extra tax. You'd walk away with around $240,000 of your profit.
Okay, after seeing a $60,000 tax bill, you might be thinking, whoa, there has to be a better way. And you know what? For many, many Canadians, there is. It's probably the most powerful tax break a homeowner can get. It's called the principal residence exemption, and you can basically think of it as a golden ticket. If the property you're selling is your main home, your principal residence, you pay absolutely zero capital gains tax on the profit. That entire $300,000 gain we talked about, it would all be yours, tax-free. You know, the perfect scenario for this exemption is actually super simple. If you bought a home, you lived in it the whole time you owned it, and you never used it to make any money, you're totally in the clear. The exemption fully applies. No problems, no tax on your profit.
But life is rarely that simple, is it? A really common situation is renting out part of your home to help pay the mortgage, like having a basement apartment or renting a spare room. Does doing that automatically kick you out of this amazing tax break?
Well, the good news is, not necessarily. The CRA says you might still get the full exemption, but, and this is a big but, you have to meet 3 specific conditions. First, the rental part has to be small compared to your personal living space. Second, you can't have made any big structural changes just for the rental. And third, this is the big one, you must not have claimed something called capital cost allowance on your taxes.
So, what on earth is capital cost allowance, or CCA? Well, it's a tax deduction. You can claim it against your rental income each year to account for the wear and tear on the property. And yeah, it saves you a little bit of tax every year. But here's the huge trade-off. Claiming CCA is like telling the CRA you're treating part of your home as a business asset, and doing that can completely wipe out your principal residence exemption on that part of the property.
So, that's how it works for your main home. But what about properties that are strictly for investment?
Well, here, the rules are very, very different, and the contrast couldn't be more clear.
This is where the difference just hits you. On the left side, you sell your principal residence, you make a $300,000 gain. Your tax bill? Zero. A big fat nothing. Now, on the right, you sell an investment property with the exact same gain. Your tax bill? Suddenly, it's around $60,000. Seeing it side by side like this really drives home just how incredibly valuable that principal residence exemption is.
Okay, so what if you do own an investment property and you know you're going to get a tax bill? Don't worry, you're not just stuck with it. There are perfectly legal and really smart ways to plan ahead and minimize the amount you have to pay.
Now, to get these strategies, you first need to understand your adjusted cost base, or ACB. This isn't just the sticker price of the property. No, it's the purchase price plus all those other costs to get it. You know, legal fees, land transfer tax, commissions. That total number is your true starting point for figuring out your profit.
The whole game here is pretty simple. The higher you can legally push your adjusted cost base, the lower your official profit is going to be, which means a smaller tax bill. So you increase your ACB by tracking every single major improvement. We're talking big stuff like a new roof or a new addition, not just painting a room. You also lower your gain by deducting all your selling expenses. And beyond that, you can get strategic. Maybe sell in a year when your salary is lower. Or if you've lost money on some stocks, for example, you can use those capital losses to cancel out the capital gains from your property.
You know, when it comes right down to it, this is all about planning. Buying an investment property is just step one. Thinking about how and when you're going to sell it and what the tax hit is going to be, that's not something you should leave till the last minute. It's a fundamental part of making a smart investment right from day one. So the real question is, are you planning for it?